Right. Then you bring what? Depreciation as well. So the depreciation, the same method, how that we calculated for that depreciation, it will be given to you. The remaining useful life of the asset. You bring it up, then you come and do. So here, because that the asset value is what? Higher than the fair value. It means that we have charged what? The depreciation that we have charged is what? Different. It's making it what? The fair value is less and the current amount is higher. So it means that we have charged higher depreciation. So we need to come and what? Take it up so that we get our total figure for the asset. So this is how that the net asset of the subsidiary is going to be done. But there is something that you need to also add up. Post-acquisition period, PUP. PUP, like I said, I will treat that one as a main this one when it comes to intra-group trading. But PUP comes in whereby the subsidiary sells some goods to what? The parent. But the parent is not able to sell all the goods. So the profit that the subsidiary is supposed to get, the subsidiary has already recorded it in his books. So because of that, now the parent was not able to sell all the goods. Therefore, we need to come and what? Do the adjustment by subtracting it. So when you calculate for PUP, you need to come and what? Subtract it here. You come and subtract it. So these are some of the adjustments you do when it comes to the net asset of the subsidiary. And this is always supposed to be done anytime maybe the examiner asks you to do consolidated statement of financial position. This is where that you normally do the net asset of the subsidiary. So ladies and gentlemen, this is how that the net asset of subsidiary calculation is supposed to be done. So let's move quickly to the third what? Workings. The third workings, basic workings. Here too, the difference between this, the asset below, no, and the depreciation also will go to group statement of financial position. So we take it also there, the difference. And this one, the depreciation will goes to the profit and loss. So they can tell you that you add it to, let's say, cost of sales. So you need to go and add it, both of it. So because that this one is negative, you will go and what? Add it to the cost of sales. But this depreciation is positive. So when you are going to make sure that you are negating this depreciation, you are negating this depreciation. It's different thing altogether. So you need to know how that you treat it. Okay, so let's go to the third workings, which is goodwill. 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 So for goodwill aspect too, we know when it comes to goodwill comes to whereby, let's say, we get goodwill when our consideration, the consideration is the price we are paying to get something. So the price we are paying, that's the consideration. So the consideration, when your consideration, anytime your consideration is greater than the net asset of the subsidiary, that's when what comes in? Goodwill. Goodwill comes in when your consideration, the price you are paying for the net asset of the subsidiary, is greater than, so if that consideration is greater than the net asset, therefore you get your what? Your goodwill. You get your what? Your goodwill. So that's the goodwill, that's when the goodwill comes in. And when consideration is less than the net asset, when consideration is less than net asset, when it is less than the net asset, when the consideration is less than net asset, then we call it gain. We call it gain. There is a gain. And we know where that we record that gain. So goodwill, specifically when you do, it will go as part of it's what? An intangible asset. So it will go under the non-current aspect. So when you are doing your calculation. So this is this is how that we get our goodwill. But we're going to go through some of the processes that we need to, let's say, get the goodwill. So before I'll get to the goodwill, let me conclude on this. Let me conclude on the net asset of the subsidiary so that you get the full concept on it. So when you are done, you sum it up to get your total. You sum it up to get your total. When you get your total, this one, the difference between the reporting and the date of acquisition, the total, the difference between the reporting total and the acquisition total, if that it is profit or loss, you call it post-acquisition profit or loss. So the post-acquisition profit or loss. So post-acquisition profit or loss. So this post-acquisition profit or loss, if it is profit or loss, you need to share it. So it's supposed to be shared. This difference is supposed to be shared between the parent and the subsidiary based on the what? The shareholdings. So if that the parent, if that, let's say we have the post-acquisition profit or loss to be 5,000, and the parent is having a shares of, let's say, 80%, the parent will take 80% of the 5,000. Then the subsidiary also will take 20% of the 5,000. So this is how that you get your what? Your post-acquisition profit, how that you share it. So this is how that you share it. So when you share it, this post-acquisition profit for the parent, this one is for the parent, this one is for the subsidiary. When you are doing workings for the non-controlling interest, for the let's say at reporting date, this one will be added to the NCI, because that's what this is what the NCI is having, the 20% of the 5,000. And when you are doing the workings 5, group retained earnings, this one also will be added to the group retained what earnings. If it is profit, it will be added to it. If it is a loss, you go and subtract it. So that's how the treatment is going to be done. So that's why I came back to make you understand how that you can conclude on the net asset of the subsidiary. So let's continue with the goodwill. So with the goodwill, we need to, because that you are going to acquire, therefore you need to know what? The consideration transfer. So the consideration transfer. Consideration transfer. So the consideration transfer. So you bring it here. Then you need to know the fair value of the NCI. Fair value of NCI. Of the NCI, I said the NCI is the number of shares that the parent is not having control over it. So that one, it belongs to the subsidiary. So the fair value of what? NCI. So, or the net asset of acquisition of the NCI, or let's say the fair value of the NCI. So that one will be stated in the question. And when you get to the workings for you, I will tell you how that you get this. So you need to also bring it. So you know the consideration transfer, you know the fair value of the NCI. So when you add these two together, it will give you the value for the business, value of the business, the value of the business. So that's this figure, the value of the business. So when you get the value of the business, you are not done. What that you need to continue with it is that you need to less net asset of the subsidiary at acquisition. So you come and less net asset of the subsidiary at what? Acquisition. And this figure will be picked from workings 2. When you come to your workings 2, the date of acquisition, the figure you get here will be the one that you bring here. Then you come and less it. So when the moment you less it, you get goodwill at acquisition. Goodwill at acquisition. You get goodwill at acquisition. When you get goodwill at acquisition, if there is any impairment in goodwill, you come and subtract it. So impairment in goodwill. So you come and less impairment in goodwill. Impairment in goodwill. So the moment you subtract the impairment in goodwill, you get goodwill at reporting. And this figure is what that you take it to. This figure is what that you take it to your statement of group statement of what? Financial position, or consolidated statement of financial position. When you are doing your what? Your non-current asset, because goodwill is an intangible asset, so you need to go and add it as part of it. So this is how that you get your goodwill. But there are some of the things that I need to explain it to you. Like, how are you going to get your consideration transfer? We have 4 basic ways that you can get the how the payment of the shares is going to be done. Because sometimes we have 4 main ways that where the payment can be done. So let's see how that one too can be done. So let me clean this one, or let me wipe this one up. Then we get to delve into how we can get the consideration transfer. how you can get the consideration transfer. So, 1, cash payment. Cash payment. Cash payment is one of the ways that a parent can make payment to the subsidiary. So that one, it will be stated directly in the question. The parent has paid, let's say, 40,000 Ghana cedis to acquire, let's say, a particular number of shares. So it will be given to you directly in the question. When you pick it, that one, the figure, you don't need to do any adjustment on it. You pick it direct. Sometimes they will tell you that there is what? Share exchange. Share exchange. Share exchange. So the second one is share exchange. Share exchange. The share exchange comes in whereby the parent, let's say, exchange shares to buy another organization. So in this case, let's say they are not paying cash direct, but they are using shares. They are using shares. That's the difference. So they can also use that means. So in this scenario, we need to be very, very tactical that when it comes to the share exchange, you'll be having 2 different share prices. They will give you the parent price, the share price of the parent, and the subsidiary share price. So in this case, since that is the parent who is making the share exchange, you need to make sure that you are using the parent share price. You are using the parent share price. You are using the parent share price. You don't need to forget. So I have some simplified example here that I want us to use so that you get to understand how that the share exchange is done. How that the share exchange is done. Okay, so the example that I have here, it says that K Limited acquired 4 million shares of 5 million shares in M Limited. K Limited acquired 4 million shares of 5 million shares in M Limited. So K Limited acquired 4 million shares from M Limited. M Limited is having 5 million shares. And the acquisition was financed by a share exchange of 2 shares for every 1,000 shares. So it is 2 shares of every 1,000 shares. Then the share price has also been given to us. We have the share prices as follows. So the share prices. So share prices. The share prices. So the share prices, the parent, which is K Limited, because the moment you do this, 4 over let's say 5 times 100 is going to give you the number of shares that the K Limited is having. And it is obvious that K Limited will be the parent. So they have given us the share price of the parent and the share price of the subsidiary, which is M Limited. So we have 4 point, let me get it correct, 4.5 here, and also we have nominal value. Nominal value. The nominal value here also is 2 cedis. Here is 2 cedis. Here is 2 cedis. And that's for the parent. And the subsidiary also is having 6.25 and 3 cedis. 6.25 and 3 cedis. So these are the share prices. The parent is having 4.5 and the nominal value also is, the normal share price is 2. But the parent is issuing the shares using 4.5. And this one is the subsidiary price. So like I said, anytime you are doing share exchange, make sure that you are always using the parent share price, because it is the parent who is issuing the shares, but not that of the subsidiary. So that's it for you. So let's check on how that we can do the calculation here. So here they are saying that M Limited, K Limited is let's say acquire 4 million shares here from M Limited, which is M Limited is having 5 million shares. But the shares, the shares acquisition is being done through what? They are saying that he has issued 2 shares of what? Every 1,000 shares. So if that you have 1,000 shares, that you are having more, you are having an additional what? 2 to add up. If you have 1,000 shares, you have another 2 to add up to. So what I will do is that so this one will be a new share that will be adding to this one. So if 1,000 new shares will get 2 shares. If 1,000 new shares, if you have 1,000 shares and it will give you 2 new shares, therefore K Limited has issued 4 million shares. So it will give us how many shares? I don't know whether you are getting me correct. Let me say what I said again. I'm saying that here we are saying the share exchange comes in whereby the parent is exchanging based on shares. So here the parent has issued 2 shares, 2 new shares. If that you have any what? 1,000 shares. So for every 1,000 shares, we'll get what? 2 additional new shares. You get it? So if 1,000 shares is giving us what? 2 shares. Therefore, if K Limited has issued 4 million shares, therefore it will give us more. So if 1,000 is giving us, therefore 4 million will give us how much? How many shares? So 4 million shares divided by 1,000 shares, because we know that if more or less divide times 2. So it will give us a total number of shares to be. Let me use my Casio calculator to punch it. So you need to be very, very tactical on it. So your 4 million shares divided by your 1,000 shares times 2. It's giving me 8,000 shares. So it means that the shares that K Limited has issued is what? 8,000 shares. 8,000 shares. 8,000 shares. So this one is not money. This one is shares. So what that you do is that the moment you get this number of shares, if you come and multiply it by what? The share price of what? The parent. So if we want to know the total amount that the parent has issued, the total amount that the parent has issued, you need to multiply the shares by what? The parent price, which is what? 4.2 Ghana. So you need to multiply it here by 4.5. Sorry, 4.5. So you multiply it by 4.5. So when you multiply it by 4.5, it is giving you 36,000. So 36,000 Ghana cedis. 36,000 Ghana cedis. So when you come to your share, your consideration transfer, if it is a cash payment, you bring the cash payment. Then you come and add the share exchange, which is 36,000. But we need to also be careful. If that examiner tells you that the share exchange has not been recorded, therefore you need to come and record it. But if that they tell you that it has already been recorded, therefore you don't have any issue about it. If that it has not been recorded, therefore we need to come and what? Share this amount between what? Share premium and what? Share capital. So this is how we are going to do it. When you say share premium comes in whereby the actual nominal price or the nominal value of the asset of the shares has not been, let's say when you are issuing, you didn't use the nominal value. So in this case, the nominal value is what? 2 Ghana cedis. But when the parent, let's say, is issuing this one, he issues what? The market price, which is what? The 4.5. So because of that, you see, if you want to know the number of shares, so let me clean this side. So we are concentrating on this side. So let me clean this one so that we'll just add up with how that things will be. So I'm going to show you how that you can share the share exchange. So the share exchange, like I said, if the examiner tells you that it has not been recorded, therefore you need to come and record it. And it's supposed to be shared between the share capital and what? The share premium. So share capital. Share capital.